So when I'm drawing out on these charts, like this fair value gap in here, in my mind, what I was interpreting was, does price want to react off of that? And if it does, I want to see how fast it can reach to the lower quadrant, which is this level here. So if we measured from the low of this blue shaded area all the way up to the top and divide that in half, that's this level here. That's consequent encroachment because it's an inefficiency on the daily chart. The lower quadrant, I want to see how fast we reach up into that. Whenever I have an inefficiency, whenever there's an imbalance at any degree of a draw, or it's ahead of a target that I'm reaching for, but I think it's ultimately going to go through some kind of let me make sure I say this correctly. Let's say that I was wanting to see 14,500, which would have been outside the scope of the price range that's being shown here. Okay, like say I believed that that's what I wanted to see happen this morning. And then we also have this daily volume imbalance still. I would not be so inclined to take all my profits off in here. I would take about half, and then 80% would be up here, and then see if I can reach that target. But because this is my target, I want to see it trade up into this area here. I want to see how fast we trade up into that lower quadrant. Does it do so real quick? Well, look what it's doing here. It's hitting the low end of it here and consolidating. Now, as soon as it does that, I'm looking at my immediately, what's the closest proximity discount array? It's this order block. But we're also trading real close to what would be mean threshold of that. So I have to make an allowance for what? There's got to be 3 PD arrays. 3 PD arrays that every single time I'm looking at price as an entry, or if I'm moving my stop loss, I have to have something that's framing it where there's 3 PD arrays that would otherwise be used as an entry. If they're not respecting price, all 3 of them fail, then I'm wrong. That's where I'm placing my stop loss. Every single time I'm moving my stop in profit, never opening it up wider. When I add a pyramided entry, sometimes it'll make the stop loss move a little bit, and then I quickly adjust it to where the risk needs to be based on three specific PD arrays. So if we're looking at this down close candle here, and on this candle here, I'm watching price. While I'm not using it as an entry because we're in the target, the low end of where I was seeing it as a draw, which is the daily volume imbalance, that blue shaded area. We can't take a we can't take a pyramid there. We got to be in the mindset of taking partials. So as it's digging in to this blue shaded area, I'm measuring how much time it takes to get to the first lower quadrant. So we hit it here on the low end of the blue shaded area. We consolidated. We have 1 discount array here. How's that a discount array if we're so far away from your entry? Because this is unrealized up here, the upper part of that shaded area. Remember I was talking about this is a implied dealing range. It means it's not there yet. So if I'm buying down here and I think that the market's likely to draw all the way up here, best case scenario, which is the terminus level of 14,467.5, the upper quadrant or upper level of that blue shaded area, that's what I anticipate seeing price do. I want to see it traverse from here all the way up to here. And I'm willing to submit to the time that it takes to get there. But is it logical? Is it sound money management and trade management for me to just simply demand that's all I get out of the trade? Hell no. No, absolutely not. And especially, moreover, if you're a new student, if you're someone that's trying to learn how to do this, you want to have logical places predetermined where you're going to take partials off and be comfortable doing that. Because taking wins with logic that repeats, number one, it doesn't feel like luck, because if you're following a process or a protocol and it's giving you the outcome that's measurable and it's gainful for you, that's not luck. You're conditioning yourself to anticipate following a procedure, a process, protocols, a model will yield you results that are favorable versus, well, last time my elbow hurt like this and it was raining, the euro went up 50 points. I could probably get 50 points today if I go in here and trade that. That's impulsive, that's stupid, and that's many times what people do. Or they sit down in front of the charts and like, oh, I got time to do something. Oh, it looks like it might go up there. Why would it go up there? I don't know. I just got a hunch. It just feels like it might go up there. And then you find yourself pushing the button, getting in those trades, and you're wondering why you're losing. Because you're not following any logic. You're not using any basis at all upon which the market itself will refer to as a reason or a catalyst for price to go higher. That's what I'm teaching you. I'm teaching you technical science. This shit does not just happen because I'm pushing a button. Just the separation between these two candlesticks here. This is a volume imbalance. Volume imbalance is the same thing that's shaded here in the blue area. That's on a daily chart. It's a larger range. Okay. Now, because this is the part where you write shit down, folks, but because you want to listen, or you're working, or you're driving, or you're doing something else, or you're falling asleep, you're not going to write this stuff down. And it's going to go right over your head. And other people are going to learn how to do this, but you were here listening to it too. But you won't get it. The higher time frame, the larger the imbalances, or like in this case, the volume imbalance, it's a larger range. The smaller the time frame, the smaller the imbalance. So if we're going to be using a higher time frame, for instance, like a 4-hour daily or weekly, I'm absolutely interested in the quadrants. Anything less than that, I'm only interested in the low, the high, and the consequent encroachment midpoint level. Because this is a daily volume imbalance, I want to know where that first quadrant is and how fast does it reach up in there. It does it real quick and energetically. And what is it telling me? What is it telling you? Where did it close on that candle? When it hit it, what did it tell you? Did it close below it? Nope. Closed above it. That is a signature. Okay? That's a signature. Listen, I'm going to tell you something right now, and I know some of you don't want to believe this. You think it's all hokey bullshit, okay? Some Tom Clancy bullshit, okay? But it's not. It's really real. The algorithm that delivers price, there is a class of trader that is actively among all of us. They're not out here trying to draw attention to themselves. They are cannibalizing everything. Okay. They have created high frequency trading algorithms to do a lot of what they do. And when these things like this happen, it tells their algorithm, like I have Enigma. Enigma is not what books price. Enigma, it handshakes with the algorithm that delivers price. And what does that mean? My algorithm would see this close above that upper quadrant and say, okay, now I can take a long if it trades down into a discount array. So it's going to have to go back through. Where are we at right now? We're here. So go back down. We have consequent correction of this wick here. Opening of this order block, mean threshold. So is it permissible to see price wick through mean threshold here, but not close? Yes. Does it do that? Yes. Does it close below mean threshold? No. Does it close below the volume imbalance here? No. So where's price going to go? Higher. Every other person that is deemed smart money, central bank level, cannibalizing traders, okay, they're out there doing these things, high frequency all day long. They're entering on this because they see this was the qualifier to say, okay, we're going to go higher. Now, if it would have closed below this quadrant level there, they're not going to take that trade. They're not going to be in it. Even if it does go up a little bit higher here, it might go there and then roll right back out of it. That's why these things are important. That's why I'm teaching it to you. Those are the little telltale signs that I call a signature that we're looking for in price. If it's not there, I'm not taking the trade. If it's not there, I'm not holding the trade. If it's not there, I'm not going to reach for another objective to take a partial. Where's the next level in quadrant? It's the consequent encroachment. It reaches energetically right here. Where's the close on it? Above it. What's that telling you? It's going to keep fucking going up. Okay? It's going to keep going up. That's logic, folks. That's how it's done. That's real fucking order flow. Save your bullshit, level 2 bullshit, okay? These ladders, these DOMs, that's all horse shit. That is all gimmick. It's fucking gimmick. Everything is measured and everything is time delivered. Everything is. You honestly fucking think that these people are going to let their entire ability to get rich every single fucking day and control the every step of every financial institution, every country, all of it's at the risk of all of us as speculators that if we all collectively got together and we short sell it, we could send this shit into oblivion, right? That's what you fucking believe? Just like the people on Reddit, just like they believe that. How did that work for them? How did that work? AMC, where the fuck's that stock at? Hmm? You're not going to beat them. It's their fucking casino. So you might as well warm up to the idea it's beneficial that it's rigged. It's a good thing that it's rigged. I wouldn't fucking trade in it if it wasn't rigged. How are you going to be able to know for certain what you're doing that has any edge? You don't. You're fucking gambling if it's like that. It's gambling if you're doing it that way. Upper quadrant. Does it close above it? Oh, hell yeah. So that means it's going to reach for what? The upper end of the inefficiency, that blue shaded area. And bang, 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 up here. See that? So let's roll this back a little bit here, give you some more detail, and we'll find our way off of the NASDAQ. All right, if you look at this low here, this is just swing projections. Excuse me. All right, so if you're looking at just these 2 points here, this low and this high, if price were to break through that, we can anticipate all of these levels here. Now, I use these levels like this one here. It's real hard to see. I apologize. But if you look real close, you'll see that that is a quadrant. I'm not a quadrant. It's a standard deviation. And it is close to that one right there. That's what? It's the first quadrant of that daily volume imbalance. And that's why we see it hit there and it consolidates. Then, reaching up into -3 standard deviation, we get 1, 2, 3, 4 times outside of these candlesticks. It's really trying to get to that level. So when I'm teaching you in Core Content Month 5, where I'm teaching standard deviations, I'm looking for these kind of agreements, these confluences of where certain PD arrays and those levels within a PD array that I are teaching you are influential in terms of price, where there's a collection of them, where they're coming together, coming together in a convergence. That's more impactful than some bullshit trend line, okay, or some kind of indicator. Because all those things that are you're adding to your chart with lipstick and stuff, that's a religion. You're believing something for the sake of believing it, versus these are factors that the market's going to reach for on the basis of inefficiency. So if we know, and I'll put it like this, if we know that it's likely to draw up into this blue shaded area, what did we talk about down here? They're Mohawks, right? I mean, you can color outside the line. It can go to where you think it's going to go, but just go past it just a little bit, because everything has to allow for what? The spread. So the algorithms that these high frequency trading algorithms are handshaking with the algorithm that books and delivers price. Make it short and sweet. The algorithm that causes the high and low of the form that's predetermined before anything happens in the day. The high and low is already predetermined. It's already predetermined. I know some of you don't want to believe that. Okay, I'll let you believe whatever you believe. Fuck your mentorships. All right, so okay, we're looking at the aspects of Mohawks. Okay, trading outside the levels, coloring outside the lines, if you will. That's what I refer to as something that's permissible. That means we don't look at it as less than efficient. We don't look at it as less than precision. We don't look at it as noise. We anticipate very specific things to see price draw to. Okay. If this inefficiency here that's shaded in blue is on the daily chart, that means that we're going to be now considering its quadrants because it's large enough to be referring to it. Contrast that with this down here. Okay, it's so small. It's not essential. There's not much of a difference between the low, the high, and let me scrunch it back up so you can see again what I'm referring to. It's the balanced price range over here that's going to act just like an inversion fair value gap. Trades down into what? If it's an inversion fair value gap, we want to see it respect consequent encroachment, which is midpoint. Can it trade to the lower end? Yes. But it's not likely to do that if it's coupled with a balanced price range where price goes up and down. So it's traversed between these two price points of this candle's body and this candle's body and that one. It's offered buy side and sell side. So it's efficiently delivered and booked price between those two price levels, which is what I'm highlighting here. But when price was trading down here, I was telling you at the time of me doing the execution, internalize it the same way I've taught you a inversion fair value gap, which would be treated as support. Now, do we simply just trade it on the high of it? You can, plus a tick or so. Sure, you can. But your stop loss has to be at least considering the fact that it can do this little Mohawk thing. It can do that right to that low if it's an inversion fair value gap. So in other words, it can create just one tick or two below that. But it's not likely, highly probable that it won't do that because it's coupled to a balanced price range where price has gone up and down within those very specific price points. That's why consequent encroachment stops it here and stops it here. The bodies confirm while you're watching price because it doesn't close below the consequent encroachment. So if we're anticipating and allowing for a Mohawk, something that's just outside the lines of what we're anticipating and seeing as impactful, noteworthy in the trade, in the tape reading, in the price delivery, we're not reducing its level of precision. When it does this, we are already expecting it. That's all that this is right here. This right here on a 1 minute chart, you can see the bodies of the candles here. But if you go up to like a 5 minute chart, that's just going to be a wick. Well, let's just do it. See how it's a wick? So this is a Mohawk inside of the daily volume imbalance. So it's not a matter of, oh, it's the algorithm's changing. Look, it's not respecting. It's doing everything that it would normally do. But your trades and how you, and if you automate what you're trying to learn from me, and you create your own algorithm, and you can do that, those things will handshake with the algorithm that delivers price. Okay, the algorithm is going to determine the high and low of the day before we start trading in midnight, New York local time. At that moment, right then and there, the high and low is already determined. It's already determined. I don't give a fuck. Your heroes, everybody out there, whatever ICT says, it doesn't fucking matter. The high and low is already predetermined. What I've given you is resources to lean on to help you determine what that is. As close as I can, that's what I've done. Now, if you know that it's a high probability that's going to create a high or low of the day based on something like this daily volume imbalance. Okay, in other words, we're bearish. We've been bearish on the indices. If we think that it's going to go up to go down, and we can run numbers on the range at midnight, then we run the range again at 8:30, run the range again at 9:30. Where's the highest high and the lowest low? And what does it still have in play for a reach or draw on liquidity? That daily volume imbalance. When we go to a daily chart, and I know, look at how much I've taught just here, and we haven't, just by 1 minute, not even a minute really on the 5 minute chart, everything I've talked about here just on this 1 minute chart. It's deep, folks. It's fucking PhD level shit. Like, I can't take 30 years and compress it into a 5 minute trainer because you're fucking lazy. I can't do that. I can't do it. No one can. Now, I can talk and introduce things conceptually, and you're going to have 1,000 different questions. But when I'm teaching, I'm teaching and I already know what questions you're going to ask. As soon as I'm saying something, I already know what questions are rising up in your head. But you have to lean on other supporting topics and things I've already made available on this YouTube channel for free. You dig into it. But you don't need to have this level of, well, madness. Okay. I need to know why it does it, not just simply, is it likely to do it? No, I need to know why it will do it. I need to know when it will do it. I need to know when it won't do it. That's the thing that's been a driving passion for me. So we see this area here as a small little deviation outside of what we were expecting, which is that blue shaded area. Okay. So now with these quadrants out, we'll take that out of there. I'll take this lipstick off. If we were looking at it from the scope of the bodies, right there, because I teach this also in the core content where price should be reaching for a range that's based on both wicks and in the bodies. Okay. And since we're looking at the 1 minute chart and we're trying to execute on the 1 minute chart, this is where you would have that there. It's calling for 71. So 71, it still has a deviation outside of that. Does that change or indicate that this algorithm is somehow now changing or morphing or no longer works? No. You have to come to the conclusion that your exits don't require perfection. Your entries don't even require perfection. If you trade with a measure of leverage that is reasonable, it's sober, okay? In other words, you're not trying to do 15 fucking contracts because Top Step said you can do 15 contracts. That's gambling. That's absolutely gambling. That's absolutely making sure that you won't be successful. All right, and this is your fulcrum point right there. So from the low to that swing high there, if it breaks above that, you can look for objectives here. And this one just falls short of that. So you never got that. And the last one on the bodies. Just falls short of that one there. Okay, so I wanted to use this one here, and I wanted to use a limit order that would have never been filled based on this logic because I was going to exit just below that by a little bit, and it never would have filled it. I wanted to have 0.75, and the high was 50. So yeah, 14,476 and a half, and I wanted to be out at 14,476.75. And had I done that, you would have seen me not get the exit, and I would have ended up closing it down here or stopped out, and missed the actual high point. But I was exiting right at the high end, above the upper quadrant, but before getting to that high of the blue shaded area. So that's how and why I managed it the way I did, and where my partials were and whatnot. But all these things in here, you're not going to find this stuff here on support and resistance. What I just outlined, all this stuff, that's not support and resistance. That's not Gann. That's not Wyckoff. That's not supply and demand. It's not anything but mine. It's a language that I created because I know things that you're not going to find in books, and no one else is going to step out here and teach you it. If they knew it, they'd be doing it. If they could come close to it, they'd be showing you. So you either make the decision, either you subscribe to the idea that these markets are algorithmic, and if you do, use the things that I'm teaching you, and it'll be easier for you to trust the time that it takes for you to learn how to do it. If you don't want to believe there's an algorithm, you're going to constantly wrestle internally that I'm wasting my time because you don't believe there's an algorithm. You think this is a free market. From here to here, right? Right? Is that right? No. What's here? Volume imbalance. So you have to incorporate that. So that's what you should have in your chart, okay? Now, because it's on what time frame, what's up here? What's this? This is a daily chart. You want to be able to add your quadrants, okay? So these are very specific levels. It's not a fucking zone, okay? It's not supply and demand zones where who the hell knows what you're supposed to trade off of, okay? It's very specific levels that we're looking for. So on a 4-hour chart, we drop down. Okay. So the market's drawn back up into this area here, right above this short-term high. This up close candle, I would not call that an order block. Why? Because it's outside the range of that daily fair value gap that's also incorporating the volume imbalance. So all of this movement back in here, I would discount all that, and I would look at a up close candle above this area here to be my bearish order block, which would be this one here. Okay, rules, folks, rules. That's what's going to be in the books. Not every up close candle is a bearish order block. So if we have our lower quadrant level here, does it want to get to that lower quadrant level? Does it do so speedily? And does it close above it when it gets there? If it doesn't, that's suspect. That means it might want to revisit all this down here. And this area here, between this down close and this up close, this little segment of price action right in here is a balanced price range. So it'll take a more meaningful move to get below this. So any retracements could be met with some kind of support in here. If we lose this area here and it comes back up and touches it, that is, in my opinion, potentially very bearish. But I can't stand the Dow. The Dow is very, very fickle. It's spotty. It doesn't want to listen many times what the other ones are doing.